Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is August 25th, 2025. I am Luna.
I am JPMorgan.
And what's really striking, I think, is this underlying shift we're seeing in central bank thinking. It's creating these significant ripple effects everywhere. Stocks, commodities, currencies, understanding how these pieces connect, that's crucial for staying informed right now.
That central bank sentiment. Yeah, feels like the main driver, doesn't it? And it translated so quickly yesterday. I mean, U.S. equities just surged. The Dow jumped, 1.9%, a new record high. S&P 500 up 1.5%, Nasdaq up 1.9%. That's a pretty clear risk-on signal.
Oh, absolutely. Investors moving towards growth. And the catalyst, as you hinted, was Fed Chair Powell's, well, let's say dovish tone at Jackson Hole. He basically signaled less aggressive policy ahead, maybe even a rate cut in September. And that optimism just spread, impacting way more than just stocks.
Right, we saw it across the board. U.S. Treasury yields, they fell sharply. Cheaper short-term borrowing, oil prices ticked up a bit, $63.07 barrel. Partly due to those Ukrainian drone strikes on Russian facilities, adding supply risk. Gold, though, pulled back slightly to $3,410. A bit of a dollar rebound, maybe. But then copper was up 0.4% to 4.48 cents.
Yeah, the dollar's weakness has been a key factor. The DXY index steadied around 97.8, but that was after hitting a 4-week low. And the softer dollar, well, it does a few things. It makes commodities like copper, priced in dollars, cheaper. Plus, overseas earnings look more attractive. It signals capital moving away from safe havens, too. We even saw Bitcoin hit a record high. Lower interest rates tend to make those riskier assets like crypto more appealing.
Okay, so the Fed's pivot is clearly the main event. We've got major banks like Barclays, BNP Paribas. They're now calling for a quarter-point cut in September. Futures markets are pricing in, an 87% chance? What's the direct fallout from this?
Well, directly, it means lower borrowing costs. Good for businesses, good for consumers. That should give a boost to rate-sensitive sectors, tech, maybe housing. Indirectly, it eases financial conditions overall, helps lift asset prices. But, and this is important, all this optimism really hangs on the next batch of economic data. A surprise there could flip the script fast.
Okay, so potential tailwind. But there's also this counterforce this week. People are calling it the liquidity sponge. The Treasury is auctioning over $180 billion in new securities. That's a lot of cash being soaked up.
It is. And the risk is, if demand for that debt isn't super strong, it could actually push interest rates up. Think of it like supply and demand. Too much supply, yields might have to rise to attract buyers. That could tighten financial conditions again, maybe firm up the dollar, and, well, challenge this bullish stock sentiment. Definitely something to watch.
Right. And one more thing to throw in the mix, a new macro headwind. The U.S. is putting an extra 25% tariff on a range of Indian goods effective August 27th.
Yeah, that directly impacts the Indian rupee. It ended last week around 87.53 per dollar. Could see pressure. And obviously, specific Indian export sectors will feel it. The broader market impact might be contained for now, but it dampens that emerging market risk appetite a bit. And it's just another reminder of how geopolitics can shift things quickly, trade, supply chains.
So heading into Tuesday, August 26th, what should you, our listener, really keep an eye on? What are the key data points?
Okay, 3 main things. First, those U.S. Treasury auctions. Watch the bid-to-cover ratios, the yields. We've got 6-week T-bills at 11:30 a.m. Eastern, 2-year notes at 1:00 p.m. Eastern. Key liquidity check. Second, durable goods orders for July out at 8:30 a.m. Eastern. Look at the core number, excluding transportation. That's a good gauge of business investment. And finally, consumer confidence for August. That's the Conference Board's index, 10:00 a.m. Eastern. Gives us a timely read on the consumer's mood, vital for spending and GDP forecasts.
Okay, so putting it all together, markets seem to be dancing to the Fed's tune right now, hoping for lower rates. But that optimism is pretty delicately balanced against this wave of Treasury supply and these ongoing geopolitical tensions.
It really is. And maybe a final thought to leave you with. If so much of this market buoyancy relies on that promise of lower rates, what happens if an unexpected data surprise comes along? Or some geopolitical shift? Could that pull the rug out from under these expectations pretty quickly? Something to mull over as you navigate the week?
You've seen the headlines, but what really moves your portfolio? Money.ai scans 1.3 million signals a day, earnings, sentiment, macro shifts, and turns it into one personalized briefing focused on your holdings. No noise, no guesswork, just what matters. Money.ai, know what moves your money.